Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, let's get into it.
Because, right now, if you just turn on the news, everyday investors are kind of hitting the panic button. We've
Yeah.
got major headlines out of the Middle East. We've got shifting trade policies coming out of President Trump's Washington.
Oh, for sure. The geopolitical noise is incredibly loud right now.
Exactly. And it's so easy to assume that the ultra wealthy are just like selling everything and running for the hills. But we're doing a deep dive today to tear up that assumption.
Right, because based on recent analysis of ultra-high net worth portfolios, they actually aren't panicking at all.
No, they're doing something completely different. They are quietly executing these massive, purposeful adjustments to the foundational plumbing of their wealth, like physically moving billions of dollars in pure cash to Switzerland.
Which sounds extreme, but there's a very mechanical reason for it.
And that's exactly our mission today. Because whether you are an everyday American investor with, $500 in a Robinhood account or a mid-level executive managing a 401k, learning how billionaires structure their safety nets can fundamentally change how you protect your own money.
It really can. I mean, the instinct for an everyday investor is to just assume volatility equals retreat. We see the news, we see the VIX index spike, and we think capital is simply evaporating.
Right, like the money is just gone.
Exactly. But capital rarely evaporates, right?
Mhm.
It relocates. Recent reporting from global financial institutions like BlackRock, for example, shows that artificial intelligence and geopolitics are basically acting as twin accelerators in the market.
Twin accelerators. What does that mean in practice?
It means they're compressing the time it takes for a geopolitical shock to ripple through the financial system. Everything is happening faster.
Wow, okay.
So because these market swings are speeding up, institutional capital is aggressively hunting for hidden, overlapping risks within their portfolios. They're checking the foundation.
Okay, let's translate overlapping risks for the everyday American investor. Because a lot of people think they're super well diversified, right?
Oh, absolutely.
Mm.
They look at their accounts and think they're safe.
Yeah, they own a broad S&P 500 index fund in their retirement account. And then they decide to be smart and buy a separate AI ETF and, I don't know, maybe a large cap growth fund.
Right, they see three different ticker symbols on their screen.
Exactly. But when you lift the hood, all three of those funds are heavily dominated by the exact same companies: Microsoft, Apple, Nvidia.
You don't actually own three different assets. You just bought three different doors into the exact same room.
Exactly. So if tech takes a hit, your entire portfolio experiences a catastrophic failure all at once. You aren't diversified at all.
Which is the exact vulnerability the ultra-wealthy are eliminating right now. They are ruthlessly combing through their holdings to ensure their assets don't share the same underlying risks.
They're making sure they don't have all their eggs in that one tech basket.
Exactly. And part of that process involves realizing that the historical safety nets are, well, they're currently broken.
You're talking about the classic 60-40 portfolio.
Right. For decades, the foundational rule of investing was 60% stocks for growth, 40% bonds for safety. It was a mathematical seesaw.
If the economy stumbled and stocks fell, central banks would cut interest rates.
Yep. And that caused the value of existing long-term bonds to shoot up. The bonds caught you when the stocks dropped.
But based on the market data from the last couple of years, that seesaw has completely snapped in half. I mean, long-term bonds and gold just aren't providing that automatic, frictionless protection we were all taught in Economics 101.
They really aren't. And the mechanics of that broken seesaw come down to stubborn inflation and a higher-for-longer interest rate environment.
Because when inflation is the primary enemy, central banks are forced to keep interest rates high.
Right, even if the economy is experiencing friction. And high interest rates are basically mathematical gravity for bond prices.
Okay, so in this specific environment, a geopolitical shock can cause stocks to drop due to, say, supply chain fears.
Yes. And simultaneously, long-term bonds continue to drop because inflation fears prevent the central bank from cutting rates.
Wow, so you fall off the stock side of the seesaw and the bond side just crushes you on the way down.
Exactly, you get hit from both sides.
So if the traditional safe havens like bonds and gold are failing their mechanical stress tests, what does actual functional risk management look like for a billionaire right now? Like, where is the structural firewall?
Well, the firewall is no longer an asset class. It's geography.
Geography, like physically moving the money.
Exactly. They are actively abandoning the idea of finding safety in specific financial instruments. Instead, they're finding safety in jurisdictional separation. They're splitting up their money across the globe to isolate their foundational wealth from their speculative bets.
Okay, that sounds like building airtight bulkheads on a submarine.
Oh, that's a perfect way to look at it.
Right, because if the forward compartment takes a torpedo, you seal the heavy steel pressure doors so the water can't reach the aft compartment. The ship survives.
That is exactly what they are doing. According to the data, money that was previously parked heavily in the Middle East, places like Dubai, is flowing rapidly into three distinct geographic hubs.
And the most critical bulkhead they're building right now is in Switzerland, right? We're seeing a 40% increase in cash positions for UAE clients sitting in Switzerland over the past 3 years. That's massive.
It is massive. But Switzerland's utility isn't about that Hollywood trope of, secret numbered accounts.
Right, the whole James Bond villain bank account thing.
Exactly. Modern Swiss banking transparency regulations dismantled that years ago. The real structural advantage of Switzerland today is aggressive jurisdictional sovereignty.
Meaning they don't take sides in global conflicts.
Precisely. In a world where the U.S. and the European Union are increasingly using the global financial system as a weapon freezing assets and imposing massive sanctions over geopolitical disputes, wealthy investors from the Middle East, Asia, and the Global South are paying attention.
Because they realize their money can be frozen with just a stroke of a pen in Washington or Brussels.
Exactly. But Switzerland maintains a strict historical stance of geopolitical neutrality. By parking pure physical cash in Swiss jurisdictions, they are mathematically eliminating the risk of their foundational wealth being seized in a crossfire between superpowers.
Okay, so Switzerland is the heavy steel door, it's the vault. But they aren't just locking everything away in a vault and sitting on it.
No, not at all. The data shows capital flowing into Asia as well, specifically dividing tasks between Singapore and Hong Kong.
Right, Singapore is acting as the structuring hub, and Hong Kong is the execution hub. Break that down for us.
That division of labor is so critical to understand. Singapore has engineered its legal system to be the absolute best place on earth to structure a family office or establish complex generational trusts.
So it's where you build the legal framework. It dictates how your money is taxed, how it's governed, and how it's passed down.
Right. But when it's time to actually deploy capital into risk assets, like when you want to buy into the volatile, high-growth Asian technology sector, you move to Hong Kong.
And we are seeing serious action in Hong Kong. I mean, despite all the headlines about trade wars and tariffs, there is massive demand for initial public offerings there.
Huge demand.
Yeah, companies like Victory Giant, they manufacture these specialized printed circuit boards for AI servers, or StepFun, which is a major Chinese AI startup. They are pulling in huge capital through Hong Kong right now.
Because Hong Kong offers proximity to the Chinese supply chain and consumer market, but it operates under a distinct capital markets framework. It allows international investors to freely move their profits in and out.
So the geographic strategy here is pure risk isolation.
Exactly. A billionaire can comfortably take massive, highly speculative bets on an unproven AI startup in Hong Kong because they know their safety net is perfectly secure.
Right. Even if the Hong Kong company goes to zero or a sudden regulatory crackdown wipes out the sector, their foundational cash is completely unreachable. It's sitting quietly in a Swiss vault governed by entirely different laws.
That's the alpha right there. And because these investors have established that absolute bulletproof safety net in Switzerland, they actually have the freedom to take on massive illiquidity elsewhere.
Which perfectly explains why they are diving so heavily into private credit right now.
Yes, exactly.
Now, for our beginner listeners, let's just clarify. Private credit is essentially non-bank lending. So instead of a mid-sized American manufacturing company going to Chase or Bank of America for a loan to build a factory, they borrow money directly from a private fund pooled together by wealthy investors.
That's exactly it. And since those public bonds we talked about earlier are acting weird, the wealthy are replacing them with these private loans.
Right, they're replacing the yield. But they are approaching the asset class with extreme surgical precision.
Well, they're getting incredibly picky. At a recent HSBC Global Investment Summit, leaders from major private credit firms like KKR and Ares made it very clear what's happening.
And what's the main takeaway there?
That the stress in the financial system isn't really coming from widespread corporate bankruptcies. It is coming from liquidity crunches. The pressure of keeping interest rates high for years is draining the cash reserves of these borrowing companies.
Okay, I'm going to push back hard on that narrative for a second.
Go for it.
Because according to the very same reports coming out of these summits, the expected default rate for private credit borrowers in 2025 is projected to hit a record 9.2%.
That's true.
Nearly 1 in 10 of these companies is expected to fail on their debt obligations next year. If you are an investor looking at an asset class where nearly 10% of the underlying assets are mathematically projected to blow up, that sounds fundamentally toxic. Why would the smart money touch that, regardless of how strong their Swiss safety net is?
Well, it would be fundamentally toxic if they were buying an index of the entire private credit market. But they aren't. They are weaponizing the capital stack.
What does that mean, weaponizing the capital stack?
When a company defaults, the losses don't hit every investor equally. The ultra-wealthy are exclusively funding what's called senior secured debt.
Ah, okay, so they are at the front of the line.
Exactly.
Yeah.
It means if the company goes bankrupt, the private credit fund has the legal right to seize the physical assets, the real estate, the machinery, the intellectual property, before anyone else gets a single dime.
So they can absorb a 9.2% default rate because the underlying collateral protects their principal. They just take the factory.
Exactly.
Mm.
But more importantly, their protection comes from the specific wrapper the investment is placed in.
Okay, let's dive into that wrapper concept because honestly, this is where the everyday investor gets completely crushed.
They really do.
We are seeing a massive push right now by giant asset managers, places like Blue Owl and Carlyle, to sell semi-liquid private credit funds to everyday retail investors.
Yes, the semi-liquid products.
Right. And these products promise that you can get the high yields of private credit, but you can also pull your money out if you need it. But right now, those retail-friendly funds are facing intense redemption pressure.
It's a huge problem.
People are panicking, trying to get their cash out, and the system is just seizing up.
And this is the most vital lesson an everyday investor can learn about market mechanics. A semi-liquid fund is a structural contradiction. Think about it. The fund manager takes your cash and loans it to a mid-sized company for 5 to 7 years.
That money is physically gone. It has been spent on building a factory or buying equipment.
Exactly. But the fund simultaneously promises everyday investors that they can log into their brokerage account and withdraw their cash at the end of the quarter.
It's like trying to sell the plumbing out of a house overnight because you suddenly need to pay rent.
That's a great way to put it.
You can't liquidate the pipes without destroying the entire value of the property. You're locked in.
Right. And when thousands of retail investors panic at the same time and hit the sell button on these semi-liquid funds, the fund simply doesn't have the cash to pay them.
So what happens? Do they just say no?
Well, when a semi-liquid retail fund is forced to meet a wave of redemption requests, the fund manager has to start aggressively selling off the underlying loans to generate cash.
Let me guess. They sell the best stuff first.
Every single time. They sell their best, most reliable loans first because those are the only ones buyers will quickly purchase.
Which leaves the remaining everyday investors stuck holding a fund filled with the absolute worst, highest risk garbage.
Exactly. It is a total death spiral.
So how does the billionaire avoid the death spiral?
By completely abandoning the illusion of liquidity. The ultra-wealthy invest in closed-end funds.
Yeah.
When they commit capital, they sign legally binding agreements locking their money up for 7, sometimes 10 years.
So no one can pull their money out early no matter what.
Nobody. By intentionally freezing their own liquidity, they mathematically eliminate the risk of a bank run. If the market panics, the fund manager isn't forced into a fire sale of their best assets.
They just sit back, collect the high interest payments, and ride out the storm.
Exactly. The wealthy accept total illiquidity in private credit because they know their emergency cash is sitting safely in Switzerland.
Wow. That is a brilliant mechanical breakdown. The structure of the fund is actually more important than the asset itself.
100%.
Now, let's pivot from the debt side of the portfolio over to the massive growth engine, artificial intelligence.
Oh, this is a fascinating shift right now.
Because the narrative for the last 2 years has just been that AI is a gold rush, right? Just
Right.
buy anything with the letters A and I in the prospectus and you'll get rich.
Right, the hype cycle.
But the data shows the ultra-high net worth capital is applying the exact same structural ruthlessness to AI that they apply to private credit.
Absolutely. The theoretical phase of AI valuation is entirely dead. Institutional capital is no longer funding companies that are just, generating amusing poems or drawing pictures of astronauts.
We're past the parlor tricks.
Exactly. The focus has violently shifted to measurable physical productivity. For instance, we are seeing major institutions like Citigroup utilizing AI not as a novelty, but as core
What
infrastructure.
are they actually doing with it?
They are deploying AI models to execute massive data migrations across international servers and automate millions of lines of legacy code overnight. They're actively cutting raw operational costs. The demand now is for undeniable utility.
Okay, so a lot of financial media still uses that tired gold rush analogy, telling people to stop buying the prospectors and start buying the companies making the shovels and pickaxes.
I hear that one constantly.
Right, but I think a much better analogy for what the wealthy are actually doing is building the power grid for a new city.
Oh, I like that.
Because you don't know if the residents of that city are going to buy Samsung televisions or LG televisions or Sony televisions. Trying to pick the winning software company is a gamble. But you do know that every single one of those televisions has to plug into a wall.
Exactly.
So the wealthy are buying the companies that manufacture the copper wiring and the power plants.
The power grid analogy perfectly captures the mechanics of the current capital flow. Because trying to pick the winning AI software application exposes you to massive software repricing risk.
Repricing risk, how so?
Think about it. If a new AI model suddenly makes coding so cheap and easy that any college student can build an enterprise software tool in a weekend, the massive profit margins of today's legacy software giants will instantly collapse.
Wow, their economic moats will just be drained overnight.
Exactly. Which brings us back to that company in Hong Kong we mentioned earlier, Victory Giant.
Right, the circuit board company.
Yeah. They don't make the software. They don't even make the cutting-edge NVIDIA chips. They manufacture the highly specialized printed circuit boards that those chips have to physically plug into.
Because those chips run incredibly hot.
Super hot. Normal circuit boards would literally warp and melt under that kind of stress. Victory Giant holds the complex manufacturing patents to build boards that can survive the heat.
So regardless of which American tech giant wins the AI software war, they all need those specific heat-resistant boards.
Exactly. It is pure infrastructure.
But even within that infrastructure layer, the wealthy are heavily screening for obsolescence risk, aren't they?
Oh, absolutely. This is critical. At a recent summit, analysts from Schroders raised major alarms about the sheer volume of capital pouring into data centers.
Because an everyday investor might buy a real estate trust that builds data centers, thinking, hey, it's a safe, hard asset.
Right. But the technological decay is terrifyingly fast right now. A $40,000 AI chip installed today might be functionally obsolete in 36 months.
That's crazy.
And the power and cooling requirements for the next generation of hardware might make the physical building you just constructed completely useless.
So it's like building a $1 million garage for a specific sports car, and then 3 years later, the manufacturer makes the car 2 feet wider and it no longer fits through the door.
Yes. You own a useless building.
Unbelievable.
Precisely. Which is why ultra-high net worth capital is demanding extreme supply chain dominance. They aren't just buying the grid, they are buying the irreplaceable choke points of the grid.
All right, we've covered a massive amount of highly technical ground today, breaking down the exact mechanics of how the elite navigate chaos. Let's pull all of this together into actionable takeaways for the everyday American investor listening right now.
Sounds good.
First, when geopolitical noise spikes, recognize that your current diversification might just be an illusion. You need to mechanically check your 401k or brokerage account for overlapping risks. If you hold an S&P 500 index fund and a NASDAQ heavy tech fund, you do not have 2 different engines. You have one engine heavily exposed to 3 companies. Spot on. Second, you really need to understand the mechanics of liquidity. If you are going to chase the high yields of private credit or real estate trusts, you must look under the hood at the wrapper. Right, check the plumbing. Exactly. If the fund manager is buying assets that take 5 years to sell, but promising you that you can withdraw your money tomorrow, you are walking into a structural trap. Acknowledge that true safety often requires giving up the illusion of instant access.
Fantastic point. And finally, when investing in the AI revolution, look for the power grid, not the appliances. Avoid the software companies whose profit margins can be erased by cheaper code, and hunt for the physical, irreplaceable infrastructure that the entire industry relies on to function.
That really is the key. The defining difference between the amateur and the professional isn't the ability to predict the future. It's the architecture of their foundation.
The structural setup. Exactly. If the investors with the absolute best resources on the planet are going to the extreme lengths of using international borders to physically separate their emergency cash from their aggressive risks. You really need to ask yourself about your own financial life.
That's a great point.
Are your safety nets mathematically isolated from your gambles? Or, when a storm hits, will you discover that everything is tangled up in the exact same web?
That is the ultimate question to audit your own portfolio. Check your foundation, untangle your web, and make sure your vault is structurally isolated from your casino. Don't forget to subscribe and hit that like button.